Ahmadu, Bello, University, a citadel of great learning.
Thank you very much. You may please be seated. The Vice Chancellor, Chairman of the occasion, other members of the high table, distinguished ladies and gentlemen, please permit me to continue with my recognition and the invitation to the high table. Because the Chairman Public Lecture Committee, as far as this public lecture is concerned, from the Department of Economics, is Professor M.C. Duru. Please. Let me also recognize other senior professors from the Department of Economics. They include Professor Muhammad Usman. Sir, you are most welcome. Professor Mohammed, most welcome. Professor Peter Injofoti, Professor Salamatu Idris. Let me collectively welcome all deans, directors, head of departments, professors, other staff, students, as well as other guests who are in our midst. It is my honor to welcome all of us to this public lecture organized by the Department of Economics, Ahmadu Bello University, Zaria, with the topic Contemporary Issues in Monetary Policy Formulation and Implementation, a case study of Nigeria, to be delivered by our guest lecturer, who sincerely happens to be a successful economics, whose sojourn, even as Deputy Governor of Central Bank of Nigeria, was momentous. Malam Suleiman Barau, OON, is an alumnus of this great university. Like I have said earlier, is an expert in investment and financial issues. So, having said so, Mr. Chairman, permit me to invite for his welcome address the head of Department of Economics, Professor Suleiman.
Thank you, ANC. Good morning, all. The Vice Chancellor of Ahmadu Bello University, Zaria, Professor Adamu Ahmed, ably represented by the Deputy Vice Chancellor, Advancement, Research and Innovation, Professor Aliyu Sanusi Rapindadi, Directorate of University Advancement and International Relations, Professor Sani Abba Aliyu, MNI, our esteemed and dedicated alumnus of the department, who is a graduate of 1981, who is the presenter of today's public lecture and at the same time an investment and financial expert in person of Malam Suleiman Barau, OAN. Let me once again, on behalf of the department and the university, condole you on the passing of your elder sister, Haji Rahmatu Ilyasu Barau. May Allah grant her Jannah. The director of CBN Center for Economic and Finance, and at the same time, the chairman of this important gathering, Professor Awalu Haruna, the Dean of Social Sciences and the Dean of Management Sciences, other deans here present, head of department here present, our professors here present, my colleagues in the academia, invited guests, our dear student, gentlemen of the press, ladies and gentlemen. It is with great pleasure and excitement that I cherish the contemporary issues in monetary policy formulation and implementation, a case study of Nigeria. I'm sure many of you, like me, will agree that monetary policy formulation is an integral mandate of the Central Bank of Nigeria. Chairman, sir, invited guests, I'm sure it will be exciting as we listen to the presenter who was a member in the design, formulation, and implementation of this policy for Nigeria. Secondly, I am sure that we will learn a lot during the discussion of some key indicators, such as monetary policy rate, cash reserve ratio, liquidity ratio, asymmetric corridor, exchange rate management, impossible trinity, quantitative easing, etc., in the formulation of monetary policy for Nigeria. Finally, on behalf of the staff and students of the department, I would like to thank you all for finding it worthy to be with us today to discuss an in-depth analysis of Nigeria's monetary policy formulation and implementation. I implore you all to fully participate in the deliberations. Thank you all.
Thank you, Head of Department. Next is an opening remark by the Vice Chancellor, Ahmadu Bello University, Zaria, Professor Adamu Ahmed, who is ably represented by the Deputy Vice Chancellor, Advancement, Research and Innovation, Professor Aliu Rafindadi.
Of the greatest sponsor, Aluta Waga, Supremo Wakanda. I want to economize, I want to demand, I want to rationalize, I want to introduce, even the modern sponsor for our activity, GBC. Bosa.
Assalamu alaikum warahmatullahi ta'ala wa barakatuhu. Chairman, sir, permit me to welcome our August visitor in August, Malam Suleiman Barau, OON, former Deputy Governor of the Central Bank of Nigeria. His friend and alumnus of this great university, who has taken time and find reason to be here with us this morning. All directors here present, in particular, Director of University Advancement and International Education, Professor Sani Abba, the deans that are here, especially of social sciences and of management sciences, our host, the head of Department of Economics, all the professors that are here seated with us this morning, our students, invited guests, ladies and gentlemen, the Vice Chancellor, Ahmadu Bello University, Zaria, Professor Adamu Ahmed, is unable to be here because of other pre-commitments. He is receiving some reports at the moment. He's asked me to be here. Although he knows I have a role here, he said, wear my cap. So I'm here on his behalf to give this brief opening remark. I would start by thanking the Department of Economics for organizing this public lecture, and especially for inviting this alumnus of ours who is an economics expert and finance expert, who has been to the field, to the industry, and for choosing the topic where his competence is the most because he was part of the monetary policy formulation and implementation in the last 2-3 decades. So we don't have any other better person to come to speak with us on the formulation and implementation of monetary policy in Nigeria at a level that my monetary economic students would appreciate than this, our August visitor. Believe me, you will learn a lot. I would also learn a lot. Having to hear from those who have participated in the design of the monetary policy framework we are currently implementing. So I would encourage you, participants, especially my students and colleagues, to pay rapt attention, to engage deeply in this public lecture. The university encourages and will continue to support departments to organize events such as this that bring together industry to the academia for 2 reasons. One, we have realized and are committed to redirecting our research and teaching to what the industry and the society at large requires and needs. And there is no better way of doing this than calling and listening to those in the industry so that we'll begin to shape the questions we interrogate to suit the issues that they are raising. Our August visitor selected a number of issues relating to the topic, design and implementation of monetary policy, to discuss. I encourage you to pay attention to each of these issues he brings to the fore for discussion, and for my students to consider them as potential issues for their research. Or when they do that, then they are directly participating in resolving a real life economic problem that requires research for resolution. I would like to, I have already introduced the guest lecturer. So I would like to encourage you once again to please pay attention, where possible take note, and please feel free to ask questions that you may find in your class, especially the Masters and PhD students. So I wish you all successful deliberation as I formally declare this event open on behalf of the Vice Chancellor, Professor Adamu Ahmad. Good morning all.
Thank you. But I believe the Vice Chancellor deserves much more rousing and warming applause, please. Thank you very much. May I now invite the chairman of this occasion, who happens to be the Director of CBN Center of Economics and Finance, Professor Awalu Haruna, to also give his remarks. Chairman.
The Vice Chancellor, sir, I believe I can stand on the protocol, except to mention two people, our guest lecturer, who has been an old friend, a colleague for many years, and who is not only expert in practical finance and investment, he's also a policy expert. And then our good friend, I am tempted to call that name we used to call. Okay, you see, I should be careful, so I will not call that name. It is my pleasure and honor to serve as the chairman of this important gathering. As we know, there is no better time than now to discuss issue of monetary policy, and especially in the way the lecture was defined, looking at the formulation and implementation in contemporary context and as applied to Nigerian situation. As students of economics, finance and management in total, we do understand how monetary policy stands at the will of every nation, because it defines and measures the impact of inflation, exchange rate, and ultimately defining our standard of living. Yet we see in recent years, Nigeria's monetary policy landscape has faced unprecedented tests that sometimes one is tempted to say define our economic logic and the kind of implementation we have. We see persistent inflation, exchange rate volatility that is making our life almost valueless. So I believe today's discussion is not about abstract theory. As I said, Suleiman was an investment banker who sees the market from the other side, and he's on the policy side at a point in time. So we believe we are going to have a rigorous practical discussion that we believe at the end of the day, the lecture will provide us with the opportunity as academicians, practitioners, and policymakers, and even students, to have some level of interrogation in terms of choices. And I believe also we would critically examine the coordination between fiscal and monetary authorities. So I urge us to pay attention in this gathering. And I believe his own context would go with the adage that we say in Hausa, idan akwai ka'ida, amma babu bin doka, to tsarin zai rushe. That is, the implementation of whatever policy that we have, if it's not well articulated, to come to nothing. That is why possibly we're having difficulty in the monetary policy pathways. And I also take this another adage before I close. We always say that duk wanda bai shirya ba, lokaci zai shirya shi. So on behalf of the organizing committee, I thank our guests, and I hope we are going to have a breakdancing discussion that we have a new life. Thank you very much.
Yes, I saw Dr. Lavi. You know, you have an assembly of the class of 80s here. So everything should reflect what transpired at the time. Mr. Chairman, permit me please to recognize the presence of Dr. M.T. Jume of Department of Economics. I've drafted the name, but I forgot to. So you are most welcome. So it is now time to start the most serious. Any other aspect is serious, but this is one of the most, because it is the reason why we gathered here today. Mr. Chairman, permit me to invite for the citation of the guest lecturer, the Director, Institute of Development, Research and Training, IDRT, Dr. M.K. Salihu, also from Economics Department. Read the citation. Doctor.
Thank you very much. All right. Standing on the established protocol, our guest speaker, please, will you stand up? All right. Distinguished chair, eminent guest, ladies and gentlemen, it's my honor to present the citation of an exemplary public servant, banker, and corporate leader, Malam Suleiman Barau, officer of the Order of the Niger, fellow of the Chartered Institute of Bankers of Nigeria, and fellow of the Nigerian Institute of Management. Born on 14th August 1959, Malam Barau's formative year prepared him for a life of rigorous scholarship and service. He earned a bachelor's degree in economics from the prestigious Ahmadu Bello University, Zaria, in 1981, followed by a master's degree in economics from the University of Jos in 1988. With a keen commitment to continuous learning and executive excellence, he obtained a postgraduate certificate in management research from the University of Bradford, England, in 2010, and pursued advanced executive programs at world-class institutions, including Harvard Business School, Harvard Kennedy School, Stanford Graduate School of Business, INSEAD, Columbia University, Kellogg Schools of Management, and the University of California, Berkeley. Malam Barau's professional journey spanned more than 4 decades across public service, banking operation, monetary policy, and corporate governance. He began as a principal economist at the Nigerian Mining Corporation between 1982 and 1988, before transitioning into banking, where he served with distinction at Continental Merchant Bank, Bank of the North, United Bank for Africa, and FSB International Bank, rising through roles up to general manager and executive committee member by 2005. He subsequently took on national service at the Central Bank of Nigeria, beginning as a special advisor to the governor in 2005, and from December 2007, embarking on a decade of leadership on the CBN board. His stewardship at the Apex Bank is both deep and broad. He served multiple tenures as Deputy Governor Operations, Deputy Governor Corporate Services between 2007 and 2017, culminating in his role as Deputy Governor of Corporate Services from September 2016 to December 2007. In this capacity, he oversaw critical reforms as well as contributed to the growth of the Central Bank of Nigeria. Some of the key activities which he helped strengthen include the institutional changes and operational resilience, and contributed immensely to political and policy stability. He was a member of the Committee of Governors and the Monetary Policy Committee from 2007 to 2017, helping to shape monetary policy through a period of domestic and global uncertainty. He coordinated the Financial System Strategy 2020 initiative, a forward-looking blueprint aimed at deepening Nigeria's financial system and accelerating inclusion and positioning our market for competitiveness. Beyond the Central Bank of Nigeria, Malam Barau has contributed to the governance and transformation of major institutions. He is chairman of the board of Red Star Express, chairman board of directors of Guarantee Trust Holding Company, chairman Fahrenheit and Pharmaceutical Limited, chairman classes, conferences and workshop classes, conferences and workshop. At Harvard Business School, Stanford GSB Management for Innovation and Sources, as well as INSEAD achieving outstanding performance. He has a executive forum on reserve and official sector asset management, IMF workshops on reserve management and governance, the African Development Bank and World Bank annual meetings, as well as several other conferences. He has spoken on Nigeria trajectory as a financial hub, both at Harvard and African Business Club in 2007, and has been consistent in championing sound governance, ethics, and performance in public and private institutions. Throughout his journey, Malam Barau has paired competence with character. He is a member of the Nigerian Economic Society, the Institute of International Strategic Study, and the National Geographic Society. His contribution to nation building and to the financial system have been recognized with one of Nigeria's distinguished national honors, Officer of the Order of the Niger. He's also Alumnus of the University of Jos. As a steady-handed, reform-minded, and unafraid to take on the hard work of institution building, whether guiding monetary policy, strengthening corporate governance, or mentoring the next generation of leaders, his touch has been marked by diligence, humility, and strategic clarity. He balances this commitment with devotion to his family as a husband, father, and grandfather. Today, as we gather for this public lecture, we do so in recognition of a leader who has traversed the full arc of Nigerian financial ecosystem, from the engine room of banking operation to the boardroom of national policy, and onward to the frontier of corporate innovation and social impact. His insights are forged from experience, his convictions from service, and his message from a lifetime dedicated to building resilient institutions and a stronger Nigerian economy. Distinguished ladies and gentlemen, please join me in warmly welcoming our
Mr. Chairman, permit me, by way of protocol, to, I'm not supposed to. having read the citation, I expected the doctor to hand over the mic to the presenter without it, but yeah. So please, it's my honor to once again invite our guest lecturer.
Thank you very much to the person reading, the citation. I will speak like my former boss, Professor Soludo. Whenever they read his citation, he will say that he's wondering whether it is him they are talking about. So I wonder whether it is me, the way he has polished, my CV and presented it. Thank you very much. I normally will sign an unwritten agreement with MC to stand on existing protocol because I don't want to miss an important recognition. So let me say, like they say in Nigeria, that I stand on existing protocol. Having said that, the VC, ably represented by my colleague on the Monetary Policy Committee, Professor Aliyu Ndadi. Let me say that I'm happy when I saw that the prof is part of this session. In fact, he's the discussant. So at the end, I saw from the program that it's a question and answer series. So if there's any difficult question, I'll just parry it back to him. He's a more recent participant in the Monetary Policy Committee than me, who left the committee 8 years ago. Other distinguished professors, directors, deans, doctors, and other senior officials of this great university, my colleagues, the students, I'll say my colleagues, the students, because even though I left the university several years ago, I am still a student. I was just telling Professor that I just finished my BA in Islamic Studies just last week. So I'm very happy. I am very, very, truly happy to be with you today. I think it's a privilege, for me, to be here. On a light note, like I said, as I prepared for this event today, I ponder how I should dress. Which kind of dress, should I wear? This is because in the ABU that I was, when there is a public lecture like this, at FAS, Faculty of Arts and Social Science, where I was, there are normally two contending groups. One group is led by Dr. Yusuf Bala Usman, who represented the Marxist and socialist groups in those days. Professor Yusuf Bala Usman will come with a t-shirt to that Dr. Ibrahim Tahir then, who classified as bourgeois, scholar. And he will come in a flowing gown like myself. So I said, when I'm confronting students, I hope that you will not categorize me as a capitalist too. In any case, like I said, some of these issues have been resolved. Ultimately, my experience as an economist has shown me that ultimately what matters is which system delivers the best for the largest, for the majority of the people in a country. It doesn't matter which route you follow as far as I'm concerned. And in any case, like I had said, some of these contending issues of the 80s have actually partially been resolved. So let me thank once again, the VC for the opportunity to stand before you. I also must thank Professor Sani Abba. I must thank Professor Awalu Haruna, who was my colleague as a banker before he defected. A more honorable role that he has played. And let me thank Head of Department, Professor Suleiman, for this. And I thank Students Association for hosting me. I'm here in my personal capacity. Yes, I am the chairman of GTCO and former deputy governor of Central Bank. Whatever I'm going to say, as somebody who has paid his dues in Nigeria, is in my own personal capacity, and I'm entitled to take a position. So consider it as my own position. I'm happy that I'm doing so here in this facility that the CBN kindly provided, and I'm very happy that I was part of the group, of the team. Thank you very much. So let's go back to our topic. What is monetary policy? In broad terms, and for our purposes today, monetary policy refers to a combination of measures designed to regulate the value, the supply, and the cost of money in an economy in consonance with the expected level of economic activity. For most economies, the objective of monetary policy includes the achievement of price and monetary stability, promotion of employment and output growth, and maintenance of balance equilibrium. These objectives are necessary for the attainment of internal and external balances, including the achievement of long-term growth. To achieve these objectives, the direction of monetary policy could either be expansionary or contractionary. Over the years, monetary policy has played significant roles in stabilizing the global economy and increasing output. Notable examples include the role of monetary policy during the Great Depression of the 1930s in the United States of America, when the Federal Reserve Bank, which is the equivalent of our central bank, jettisoned the gold standard, allowing more flexibility to expand money supply. In similar vein, during the World War II, monetary policy in the United States and other major economies was primarily focused on financing war efforts, controlling inflation, and ensuring financial stability. Still in the US, the Federal Reserve System cooperated closely with the fiscal authority to support wartime spending, marking a unique period where monetary policy was largely subordinated to fiscal and indeed monetary goals. Furthermore, the post-World War II economic stabilization in Germany benefited extensively from monetary policy. In 1923, for example, Germany introduced a new currency called Rentenmark, which was backed by real assets, which was also complemented with tightened monetary control in order to achieve to restore price stability and public trust. Also in Japan, the period 1990 to 2000, year 2000 is normally regarded as the lost decade. There was an asset bubble bust, as you will recall, across real estate and the stock markets, leading to prolonged stagflation and deflation. Monetary policy subsequently came to rescue the problem through massive cuts in interest rate and, of course, quantitative easing, which provided the launchpad for their economy to recover out of the recession. The historical perspective that we lay here will not be complete without the recent global financial crisis of 2007, which started in 2007, and the global pandemic of 2019. The global financial crisis, I was part of the Monetary Policy Committee at the Central Bank, and I know what we went through to be able to stabilize the economy. But indeed, we also have seen the global pandemic, which in both cases, monetary policy entered the central space to avert what could have been loss of our economy. Now, let me come back to monetary policy in Nigeria. In Nigeria, monetary policy started in 1959 when the Central Bank of Nigeria, which was established in 1958, began operations. From that time to date, monetary policy has played a pivotal role in shaping the direction of our economy. Significant milestones include the role of monetary policy in the prosecution of our unfortunate civil war in the late 60s, support for growth of the industrial sectors in the 70s, and relative stability of the 70s up to the 80s, as well as the restoration of economic activity in the aftermath of the global financial crisis in 2007-2009, and the resilience of the economy to commodity shocks that we witnessed sometime in 2014 to 2016. Through the management of exchange rate, monetary policy has equally helped in promoting healthy and orderly development of the financial system at large. Because for us, the central bank is not just a monetary policy institution, it's also a financial system regulator and supervisor. Orderly development of the financial at large and the banking system in particular. Given that the financial system is the catalyst for economic growth, it can be reasonably inferred that monetary policy has made a substantial contribution to economic and social prosperity of our country. Now, let me turn to CBN and its role in monetary policy. The principal objects of the Central Bank of Nigeria, as embodied in its Act of 2007, as amended, major amendment at that time include: number one, ensure price and monetary stability. Number two, issue legal tender currency in Nigeria, which is the Naira. It's the only institution that is empowered legally to issue currency. Maintain external reserves to safeguard the international value of the legal tender currency, which is the Naira. Number four, promote establishment by the Central Bank of Nigeria from 1950 with the main instrument of monetary exchange rate. It was exchange rate targeting. Nigerian pound was fixed at par with the British pound. Suggested that monetary policy was largely dictated by the prevailing economic conditions in the UK, in Britain, which was the issuer of the pound. The fixed parity lasted until 1967, when the British pound was devalued, prompting Nigeria to peg its currency then to the United States. The pegging to the US dollar ended in 1973 with the devaluation of the US dollar as well, following the international financial crisis of the early 1970s. The Naira was therefore repegged to the British pound. Several drawbacks of pegging the Nigerian currency, which in 1973, I believe, became Naira, a single currency became obvious. For example, the UK economy was confronted with several severe pressures in the 70s due to weak macroeconomic fundamentals there. Therefore, the Naira was pegged to a basket of 12 currencies of Nigeria's major trading partners. By the late 60s to 70s, most countries around the globe began to just hard peg exchange rates, given that the framework does not permit independence of monetary policy. Besides, there was vulnerability of the economy to weakness in the country of the ample country. As such, in 1978, following shocks, a series of shocks that disrupted the macroeconomic conditions in most countries' trading partners, those 12, the need to independently manage the exchange rate of the Naira was firmly established. So that was when we migrated from exchange rate targeting to monetary targeting. From the 70s, the economy witnessed a major structural change that affected the conduct of monetary policy. Oil dominated export basket, 27% of total export in the 1970s and over 96% from 1980. In contrast, non-oil exports, mostly agriculture, declined from 42.4 in 1970 to 16.9 in 1973. Nigeria's external reserves also rapidly rose over 1,000% in 1975 from about US dollar 100 billion in the 60s to approximately 3.4 billion dollars. Those of us who are young at that time remember that the head of state was saying that money was no longer Nigeria's problem, but how to spend it. These developments gave rise to rapid expansion in monetary aggregates, which provided headwinds for inflationary pressures. In addition, the financing of post-war developments led to considerable growth in public expenditure. We all remember that time, thus intensifying inflationary pressures. Was spending left, right, and center. In response to both the domestic developments and the drawbacks of exchange rate targeting framework, the Monetary Authority adopted a new monetary policy framework called monetary targeting. The focus of monetary policy from then onward was to control monetary aggregates. A policy framework that is largely based on the belief that inflation is essentially a monetary phenomenon. The monetary targeting framework has two sub-periods, namely the direct and the indirect control periods. I'll comment on the direct period, which was between 1974 to 1992. The major objective of monetary policy during the period of direct control was to promote rapid and sustainable growth. The instruments of monetary policy were quantitative in nature, involving setting ceilings on interest rate and credit to the economy. Consequently, the Monetary Authority imposed quantitative interest rate and credit ceilings on banks, as well as prescribing sectoral allocation to the preferred sectors of the economy. Then it was largely agriculture and manufacturing. Direct control was effective in protecting the weak sectors of the economy, like agriculture and manufacturing. More importantly, it was suitable for a country with structural challenges in intermediation. People will not ordinarily lend, to these sectors. So the CBN had to come in with this measure to direct, lending to those sectors. However, the direct control was plagued with numerous challenges, including inefficiency as money and financial markets developed, distortion in allocation of financial resources, incentives for rent-seeking, and financial disintermediation. These challenges made the Central Bank of Nigeria discontinue with direct control in 1993. We then went in direct control, which has been practiced from 1993 to date. In September 1993, the Central Bank adopted the Basel Committee prescribed prudential guidelines and commenced selective removal of all credit ceilings for banks. The operational framework involved the use of indirect market instruments to regulate the growth of major monetary aggregates. Under this framework, the Monetary Authority targets the operating variable, which is the monetary base or its component, while the market is left to determine interest rate and allocate credit efficiently. The major tools under this regime are market-based instruments, including short-term interest rates, like the policy rate, the MPR that we have today, and interbank rate, open market operations, cash reserve requirements, and the liquidity ratio that we all have today. Now, I'll do a brief assessment of monetary policy. This is not an issue of value judgment. It's just a matter of looking at what had happened. We have had relative price stability. Based on CBN Act 2007 and as amended, the primary mandate of monetary policy is to ensure price stability. The import of price stability is hinged on the thesis that an endurable economic growth will remain elusive in a regime of high and volatile price levels because investment will be impossible. The stories of Argentina, Zimbabwe of today, Haiti, Iran, Ethiopia, Turkey, Lebanon at various times are enough to justify this assertion. In a nutshell, the assessment of monetary policy in Nigeria could be done by looking at our inflation dynamics. The inflation trajectory in Nigeria from 2000 to 2015 shows that inflation was well under control, as average inflation was below 10% during the period, despite the shocks caused by the financial and economic crisis. And I was at CBN at that time. It was deliberate. We actually were trying to change to inflation targeting. So we needed to really work on it. Anyway, so we've had that situation where inflation was below 10%. In other words, inflation on average was in single digits, competing favorably with many of the emerging and developed economies during the period. For ease of comparison, average inflation in Ghana, South Africa, Kenya, Mauritius during the period was 14.3, 5.6, 6.88, and 5.92% respectively during this period. Inflation trend in Nigeria, however, assumed a different path from 2016 to 2024, when it averaged 18.04%. Today is 22.24, I believe. It's still high. The adverse impact was profound on macroeconomic fundamentals. For example, at that time, most international rating agencies downgraded the economy in 2023, with spillover effect on capital inflows. The CBN resorted to various strategies to manage the naira that was there, including swaps with domestic banks, all of which could not abate the negative investor sentiment. Capital outflow assumed an unprecedented dimension, taking its toll on external reserves. This ultimately impacted on the exchange rate for the naira. Naira, during some period at that time, became one of the worst performing global currencies. The adverse impacts were not limited to the economic space, but they also affected the social and political fronts as well. We saw JAPA reach an alarming proportion, partly because of this development. The bottom line is that economic crisis was gradually leading to political crisis, thus requiring an response. I'm happy that we've gone beyond that by this time. So let me focus on the main central topic, which is contemporary issues in monetary policy in Nigeria. I would like to state from the upfront that the structures for monetary policy formulation in Nigeria are and have been of global standard in terms of legal independence, composition, policy input, and technical competence. You can imagine the composition of the Monetary Policy Committee. We usually will have two people from the academy. That's how Professor Rapindadi actually came here. Before, it was basically we, the CBN policymakers, but with the adjustment, thanks to the CBN Act, we get industry representatives, we get academic representatives, so that input is enriched and the technical competence is enhanced. The challenges that are faced are largely from outside the CBN. So the composition, the structure, and the competence is there. They constitute what are called circles of concern rather than circles of influence. Circles of concern are things that there is nothing you can do about. They come from outside your environment. These issues are multidimensional, ranging from global to domestic. Leveraging on the benefits of hindsight, permit me to share my perspective on some of these, not all, some of these issues. The first, I think, which is very, very important, as we've seen recently, is that the multiple mandates of CBN, which is good, has also posed a number of problems for the Monetary Policy Committee, unfortunately, unintentional. It is quite difficult at times to clearly identify the goals of monetary policy in Nigeria due to multiple mandates of the CBN. That is because the Monetary Policy Committee will sit and take a policy stance, but then other compelling operations of the central bank will be counter to what the Monetary Policy Committee position is. The mandate that tasks the CBN as a banker and financial advisor to the CBN, to the federal government, in addition to its role in attempts to impact on growth and inflation tapering, has made it to double into what is clearly a fiscal role. This was particularly the case between 2015 to 2023, when the bank appeared to lean heavily on the side of growth as against the primacy of price stability in its mandate. Between 2016 and 2023, CBN's balance sheet literally doubled due to a combination of ways and means advances and what was termed development finance disbursements, which it alone was estimated at about over 11 trillion naira, at a time when the annual budget of the country was less than 18 trillion. In effect, over 50% of the federal budget was at a time literally financed by ways and means, since funds are fungible. It's not that, government came by that way, even if it is not its intention to use it for budgetary purposes, but it was available for government to use. Monetary expansion to support budget, and that's why I've always advised government, when I have the opportunity on the fiscal side, that CBN should not be seen as a revenue generating institution. I've always cautioned it. All that is needed for a central bank is to credit. If the government needs 50 trillion, all that is needed is CBN will just take a decision and they will credit the account of government 50 trillion. But what are the consequences of that? We will go towards Zimbabwe. So the ways and means credit and the monetary expansion via development finance did a lot of damage to objectives of monetary policy. These disbursements were in some instances in total disregard to the stance taken by the Monetary Policy Committee. Even when such disbursements are consistent with the stance of policy, that's assuming that the stance of policy is expansionary at a time when CBN is disbursing. The monetary policy does not approve that, and does not determine the quantum of the monetary expansion. The bank at that time appeared to be focusing on growth while striving to achieve price stability simultaneously. It is well known that any given monetary framework cannot have two conflicting goals. The instruments at the disposal of the bank, which are mainly short-term interests, cannot handle the goals of growth and inflation at the same time. Multiple goals blur the understanding of economic agents, making it difficult to align their responses with the expectation of the monetary authority. This will inevitably weaken expectations and ultimately the transmission mechanism of monetary policy. Generally, empirical studies have shown a strong correlation between poor inflation outcome and multiple goals of monetary policy. Practical case studies include the experiences in Asian countries like Thailand, Malaysia, and Indonesia. Thus, in Nigeria, aggregate money supply, defined as broad money, grew by 51.86% in 2023, while GDP grew by mere 2.7%. Inflation, on the other hand, accelerated to 28.92%. So just see a higher share of money supply actually fueled inflation rather than the intention of propelling growth. These tendencies impacted negatively by driving prices and inflation to the very high levels that we have today. The next major issue is indirect external influence on monetary policy. I would like to say very categorically that while I was at the Monetary Policy Committee for for 10 years, nobody called us to say interest rate should be like this, that is MPR should be like this, or lend to this sector. Nobody, it has never happened. I will confirm that. I'm sure that Professor Rafindari will confirm that during his policy. However, some of these influences come subtly. The CBN Act 2007, as amended, guarantees monetary policy independence. An objective assessment, however, needs to accord due recognition to the jure and de facto independence. Indeed, there is the jure independence considering the statutory provisions in the Act. But the de facto independence appears to be hampered by fiscal dominance, not just by impacting the monetary policy committee. There are two classical cases of fiscal dominance, subtle political interference. The first is when the policy's rate is set with a view to passively accommodating fiscal policy. This is not normally discussed. This is not normally discussed. But when you know that there are issues with government, you tend to be sympathetic. And these are the individual, as you know, or you may know, the monetary policy committee decisions are through voting. Everybody votes before a decision is taken. So we all have, even though we are confronted with facts, with numbers, we also have our own individual consideration. So in other words, when monetary authorities decide to keep interest low with the objective of reducing cost of debt by fiscal authorities, I haven't seen that, to be honest with you, as directly discussed, but it's a risk that is faced given that individuals actually vote. This often plays out, though not explicitly discussed, in a regime of high and rising public debt, as we have today. The second is deliberate inflation financing to make the fiscal authority solvent. For example, the ways and means balances to advances to the fiscal authority was, at a time, we all know, it was in public, over 22 trillion by December. Even though I need to also be politically incorrect. Yeah, I have been told that the actual disbursement was not 22 or 23 trillion. Actually, it was 8 trillion. The actual disbursement. It was the build-up of interest over time that made the balances to rise 23 trillion. I say politically incorrect because it was also an issue that was used by politicians to attack. This is still, however, this is still way, way, way in excess of 5%. Was expressly provided in the CBN Act. In other words, lending to government is permitted, but it should not be more than 5% of the previous year's revenue, federal revenue. At a time when I was at the central bank, it was about 180 billion. So when 8 trillion was given, you can see that CBN was, I would say frankly, was in violation of the CBN Act. This is a well-known fact. All were there. So, I mean, we need to correct this. I'm happy that this has been enhanced. I believe, I understand that it has been enhanced just to make sure that government can recover. It's not healthy. There's a reason behind the 5%. But so our government, when there are exigent need for government to find financing, it can. For example, if the federal government cannot pay salaries, it makes a lot of sense for CBN to come to the rescue, regardless of the consequences. That can be addressed. The consequences can also be addressed. To give legal support to the monetary financing by the central bank, the National Assembly amended the CBN Act 2027 in 2022 by securitizing the ways and means to the federal government with a tenure of 40 years and a moratorium of 3 years, so that it's securitized in a way but the consequence of monetary expansion is still there because you haven't taken out the liquidity. This is unhelpful in the context of monetary policy and stability for several reasons. The first is the securitization that was done by the National Assembly did not provide for a secondary market trading for those securities. If it had provided, then it means that the central bank could have offloaded it. But it cannot be uploaded because there is no secondary. So it's still in the books of the central bank. The effect of the expansion is still there. The second is that by doing so, we contradicted the ECOWAS protocols that we signed. For me, that's not important. What matters is us. Not that it is not important, but we have an issue and we need to resolve it. Now, let me talk about the third issue that I see that challenges monetary policy composition. Implementation, formulation and implementation, which is the structure of the banking system as the intermediary for monetary policy implementation. The banking system is one of the main channels through which the monetary policy decisions are transmitted to the real sector. For this to work seamlessly, it is expected that the structure of the banking system should be perfectly competitive, or at least close to a competitive nature. In other words, none of the banks should have the power to influence the market and by extension alter the decisions of the central bank on interest rates. I'm not saying, and I haven't seen the evidence that this happened, but this is a risk. This is an issue that needs to be addressed. This seems not to be the case in Nigeria, as there is a huge concentration in banking assets and market share among eight banks. In Nigeria, about 8 banks, which is less than 20% in terms of numerical strength of the banks, control about 80% of the market share in terms of both credit and deposit liabilities, so that these banks are normally regarded as systemically important banks. The concentration index shows that the level in Nigeria is much higher, even when compared with the level in most emerging market developing economies. For example, the banking concentration index in Nigeria in 2021 was 59.32%, compared to 32.84, 44.81, and 38.31 in Ghana, Kenya, and China, respectively. The implication is the absence of a level playing field in the financial market. The most notable effect is in the interbank market, which counterparty risk is elevated. Today, most of the participants prefer to trade in OBB, open market buyback instrument, rather than do clean interbank lending. In other words, the trading between banks is largely secured trading rather than clean trading, because most of the larger banks don't believe in the strength and the ability of the smaller banks to pay. ODB, which is the open market buyback, as a dominant instrument, does not adequately price discovery in some instances, not in all instances, making it difficult for the regulator to assess the level of risk in the market. More importantly, the systemically important banks arguably have the wherewithal to alter monetary policy decisions in their favor, even though I can confirm that I haven't seen that, but it's a risk that we face, leading to the weakening of the transmission mechanism, thereby undermining the goal of policy. The next major issue that I see is developing is that our transmission mechanism where the financial system is still developing, still evolving, it's not mature. The financial system in general serves as a medium for transmitting monetary policy impulses to the various sectors of the economy. This, in essence, implies that the level of financial sector development is a major determinant of speed and scope of transmission of monetary policy. In advanced economies, with a well-developed credit market, particularly mortgage market and consumer credit, the impact of monetary policy is quickly transmitted to the economy. In Nigeria, the financial market is still evolving. Even though remarkable progress has been made in recent times, there is still room to improve. And the improvement is through the financial inclusion drives of the central bank supported by the banks, and of course the fintechs that have joined. When I was at the central bank, we had a target of financial inclusion, I believe is 75 by the year 2020. That is, get 75 eligible Nigerians banked by the year 2020. I'm told that that has exceeded. The level of inclusion as of December 2020 was 74%, so that has been achieved.